Welcome back, everybody. This is another week, another wealth webinar. And today we're going to talk about pivots. We're going to talk about changes. And we're going to talk about the different things that you have to do in your life to take back control of your money so that you then can take back your financial freedom. One of the things that we were talking about earlier is we were talking about if you owned a business, the ads you ran last year and the ads you ran the year before are not the ads you run now. Ads change, business change, customers change. The way we do things, the way we operate our life, the way that everything happens must change. Nothing is static. Everything's in motion. Just like your money should never be sitting still. It should always be in motion. And one of the big things I want you to understand is many people understand this, but many don't because we've been lied to. It's not your fault. It's no one's fault. To be honest, it's the institution's fault because they have found a way to get you to do exactly what they want you to do, exactly what's profitable for them. And we all comply and we get in line and we give up control of lots of things. Like that YouTube video I was so diligently trying to play, we give up control of things like freedom of speech. Oh, we can't say that. Oh, we can't do that. Clearly, like I pretty much say what I want most of the time, but we all have kind of muffled that down. But it's the First Amendment. We should have freedom of speech. And we've also been taught to do and give up control of our money. At a young age, you were taught to save money. I mean, I know in my young age, when I was a child, my mother would save money. She had a little glass jar and she would put all the extra change. When we went to the grocery store, she would take all the change and drop it in that jar. And what happened is when that jar filled up, we would empty it out, we would roll the coins, and that's how my mother bought big purchases, things like lawnmowers or anything that she needed, a weed whacker. And she would sometimes save an entire year to buy a simple thing that you and I today would just run out. And what would we do? We'd see the one we like, we'd sit on it, we'd make sure the cup holder was big enough for that oversized beer that we want when we're out mowing the lawn in the backyard, and we'd finance that puppy. We'd put it on a credit card. We wouldn't even think about the act of saving. We would just get it and worry about how to pay for it later. Now that all seems good and great. Wow, how convenient. We can have just about anything we want and we can have it right now, your way, right away. But unfortunately, what's happened is we have literally given up control in doing that. You have given up control to the credit cards. You have given up control to the banks. You have given up control to Wall Street because as far as I know, back in the day, and I mean way back in the day, my grandparents and everything, 401ks weren't even a thing. They didn't defer their pay over to a 401k and put it in somebody else's control. What did they do? Well, they got pensions and they saved on their own. They fended for themselves. They understood that the cavalry wasn't coming and it was on them. Whether that worked, that didn't work. If you look back at that generation, my grandparents, which are no longer here, they were savers because that was just how things got done. You wanted to buy a car, you saved up for it. You needed a lawnmower like my mom, you saved money in a glass jar, or however you formulated your savings plan. Today, our savings plan results in giving up control to somebody else. Somebody else then puts it wherever we tell them to or wherever they feel is best for us, and they're in control. But specifically, the biggest problem we've made, and this is all the pivot, right? If you own a business, the ads you ran last year are not the ads you ran today. The way we save for things in the past are not the way we save for things today. The way we bought things in the past are not the way we buy things today. I'm simply trying to show you the pattern, but the pattern is going the wrong direction. Because all the stuff we're doing when we feel good about walking into a bank or doing those online deposits. Hell, you don't even need to walk into a bank anymore. They've made it so convenient. All you do is you take the check out, you grab your phone, you snap a photo of it, boom, money in their bank. Win-win, right? You feel good because you pull your statement up on your phone and right there it shows your big old balance. But what that balance is just numbers on a screen. So what's really happening behind the scenes with that? Well, what's happening is you're putting money in the bank and the bank is then making the money you gave up control of, because that's indeed what you did. When you handed that money to the bank, you gave up control to the bank. They didn't take your money. They're not taking, whatever that deposit is, your paycheck from that day. They'll call this your paycheck. They're not taking this and putting it in a little box and putting it back in that vault for safekeeping so that when you need that money, you come back, they pull your little box out, slide the top, you're like, yeah, there's my money. Can you just give me like 5 of those? Great. No. The bank takes your money and it immediately sends your money out to work for the bank. The bank agrees to pay you some interest rate today, close to 0. Some of you last night were telling 0.6%. Some of you were 1% at best. So the bank's paying you 1%. And when the bank's making your money work for it, what's it charging? 3, 4, 5, 6, 7, 10, 12. I mean, it depends on the loan, depends on the security, depends on your credit score, depends on so many factors. But let's just call it 5. So if you're making 1 and they're making 5, their spread is 4. It's a big spread. And if you really did it, that's 400 to 1,300% more than what you're making. But who's at fault there? Is it the bank at fault for doing business, for making your money work because they learned how to do this? They built processes and procedures. They pivoted along the way to make it easier for them to get more control of more of your money. And you just gladly complied. You just gladly gave up control of your money and you put your money in the bank. It's not your fault. You've been conditioned and trained to do this. You can train your cat to go to the bathroom in a litter box. You can train your dog to pee on a little puppy pad if you just be consistent and persistent in how you train them. The banks and Wall Street have done a fantastic job of training us to give up control. And in giving up control, we also give up some level of financial freedom. Let's talk about that. When you put the money in the bank, you have a sense of security because your money is safe and sound with an FDIC insured balance of $250,000. However, you're not really secured because when banks go out of business, if it's more than 250, you're pretty well screwed. But not only that, is your money making you anything at 1%? No, inflation's 8.5. So do 8.5 minus 1. What are you actually making? You're losing 7.5%. So that's just today. But inflation is usually at least 3%. So if we take 3% minus the 1 you're getting, well, you're still losing 2%. The bank is not the right place to hold your money. How much money should you keep in the bank? Well, that's up to you. 3 to 6 months of your expenses. Me, I keep 10,000 in the bank. And if it's any more than that, I get cold sweats. If any of you were watching before this Zoom went live, you saw me freaking out because technology didn't work. Well, that's how I get when there's more than $10,000 sitting in my personal bank account. I freak out. Freak out. I should play that song, but unfortunately you wouldn't hear it because the computer doesn't work. 401ks are the same thing. They've made it so easy. Hell, now when you get a job, do you realize some 401ks don't even have to have you sign anything? In your initial sign up and all the paperwork you filled out, you signed over control of whatever percentage of money you are putting into the 401k. And then automatically that money just sweeps over into that 401k pre-tax. Well, let's not forget that. Grandma told me, make sure you ask if they've got a 401k because you can put pre-tax dollars and you don't have to pay tax on that money. And that's a good thing, Chris. Well, it's a good thing if taxes in the future would be going down. It's a good thing if in the future, my sole goal was to make less money. I said this last night and I'll say it again. As an advisor, I shit you not, as an advisor, one of the things we were trained on is that our clients will have a lower tax bracket in retirement because they will make less money. You ever see those stampers that just put fail on paper? Like that's what we should have stamped on our clients' heads. Fail. Because that's what we were literally taught to do. Teach our clients how to fail. Don't worry, Mr. Client, because someday when you retire, you will probably be in a lower tax bracket because you're going to be making less money. Oh, okay. Well, that sounds like a good idea. I don't like paying taxes. Hold on. Did you not hear that I just said you're going to be making less money? How many of you want to make less money in your golden years, your years when you retire, when you're supposed to be enjoying your life because you spent the last 30 years, maybe 40, maybe 20, working your ass off, trading hours for dollars? Pivot. We have to change, folks. So everything I just told you is the evolution of where my grandparents were to where we're at today. What we need to do is we need to pivot again. We need to start understanding the same marketing we did last year, the same actions we did last year are not the actions we need to do today. Although you can, if you are comfortable and you don't want anything to change in your life, you don't want to make any more money, you're fine losing money in the stock market right now because clearly that's what you're doing. Oh, some of you are thinking, oh, wait, but today the market's up, Chris. hold on. For the last 6 weeks, the market has shown a loss. Now we're up one day and you feel good that the market's going to keep going. Wait till the end of the day. There's a good chance we'll finish down because the market opens 400 and it finishes down 600, or it opens down 600 and it finishes up 200. Like, you figure that out. Makes no sense. It's because we're at the end of a cycle. It's time for a pivot. So what I want to really do is I want to talk today about the why. So I recently got a TEDx talk. Now, many of you are familiar with TEDx talks. Maybe you've seen Simon Sinek's Why, right? It's one of the most famous TEDx talks of all time. And it has more views, I think, than just about any other one. And the reason for it is he focuses on one thing. It's the why. So let me define the why without getting in all Simon Sinek with you. And then we're going to dive into some of the stuff behind me. When you buy a car, okay? When you buy a car, do you want to know all the inner workings of how that car gets you from point A to point B? How that car goes 0 to 60 in 3.2 seconds like a Tesla? No, you just want to know why you're buying. The why is the car gets you from point A to point B. The how is in some, some of you may be mechanics, and that you might wonder, oh, what kind of superchargers is that, the KO4 or the KO3? Some, but most people are just like, how fast does this car go? Cool. Because the why is how fast you're going to get to your destination. Same thing, you don't need to be a mechanic to drive a car. How many of you think you have to be a mechanic and know everything there is about fixing your car in order to drive the car? Because last time I checked, man, even, being somewhat mechanically inclined, I don't know how to fix a darn thing on cars today. You open the hood and it's just a bunch of plastic. You're like, where do you put the washer fluid? Hell, that's what it's come down to. We don't even know where the washer fluid is. I bet you a bunch of you go to the mechanic and say, hey, can you fill my washer fluid up? Because you can't figure it out. Back in the day, it was very clear where you put the oil, where you put the washer fluid. Hell, I bet you most of you that are about as old as me or even older knew how to change an air filter in your car. Remember that? Wing nut, spin it, pop the cap off, drop a new Delco one on, put the thing on, spin it. Where's your air cleaner now? You probably have to disassemble half the damn car to get the air cleaner changed. But you need to understand that in order to drive the car. No, that's what I'm trying to explain. I think a lot of people, when it comes to money, let's bring all this back to money. When it comes to money, they think they need to know everything before they take action. And by the time they know everything, nothing has happened and you've missed out on a whole bunch. The why is the most important part. Why are you investing? Okay, what is your why? It's going to be different than Shauna's why. It's different than Andrew's why. It's different than my why. We all have a different why, but at least we have a why. And if we focus on the why, the how isn't always the most important thing. It's the why that you should look at. Let's talk about those privatized banking policies, especially designed and engineered whole lives that we use. And then we basically perform a concept or a process called the infinite banking concept, which was pioneered by the late, great R. Nelson Nash. You all should read the book. The book is not just about the infinite banking concept. It's about the change, the pivot that we need to make in our mind, because we need to erase a lot of lies that we've been taught, a lot of bad habits that we've been ingrained with, and we need to start thinking like the bank. We need to start focusing on the why. So let's just hit some of the whys. Okay. Number one, you might want to get all the money back for all the cars you ever buy, drive, and own. And most of you buy now, to get all the money back for every single car you buy, drive, and own, what do you have to do? Change one thing. Change one thing. That's it. It's all right here in this little booklet. Okay. This little booklet of diagrams and big text and pictures and all sorts of stuff. This little booklet is about 62 pages long of literally typeset that is so big that if you wore those glasses with the big bifocals, take them off, you can probably make it out. This book right here shows you how to change one thing and how to succeed at the why, which is how to get all the money back for every car you ever buy, drive, and own. But then there's some people out there, I always like to pick on engineers, they want to know, well, how does that work? Well, what are the fees? Well, what are this? What are that? What are this? What are this? I need to know everything there is to know before I can get all the money. I'm not going to do this. Even though my why is to get all the money back for every car I buy, drive, and own, I need to know every single thing there is to know about this. And you know what happens? That person that wants to know everything does nothing. That person that wants to know everything never gets all the money back for all the cars they buy, drive, and own. Because in the financial world, it's not like engineering. Engineering is a finite science. If we didn't have engineers, holy shit, bridges would be falling down. You would never climb a ladder. You'd never probably even go into your house because it'd probably crash down. Engineers are the reasons why things work. But in the money game, okay, in the financial game, things are ever changing. And if you try to figure every single thing out, nothing will ever work. Just can't. So again, the why is, do you want to get all the money back for every car you buy driving home? The why could be you're looking at your financial thing. So we're developing something really cool. It's amazing. It's something we should have done a long time ago. But everything we have been doing, which all of you have probably benefited, and you know, how many of you are brand new here? Let me ask this. How many of you are brand new to the wealth webinar, or this is like one of your first time seeing me? Give me an I in the chat. I just want to know how many are brand spanking new to this. Okay, perfect. Third week, a bunch of people are, this is their first time. Awesome. Well, hey, first off, for you first, second, third, and 300th timers, thank you. You're making that change. You're starting to think different. You're starting to act different, and you're starting to focus on your why. Back to it. So if this is your first time and you've never seen the money multiplier, some of this might be a bit foreign, but it's okay. We got lots of videos that will teach you that. So again, back to your why. What is the why? You know, what are you trying to accomplish? Many people that we come across, they're trying to build wealth. But first you have to understand that wealth takes time. Wealth is a marathon. It is not a sprint. If you're trying to sprint your way to wealth, you will definitely be about as frustrated as I was trying to figure out why the stupid volume wouldn't work. Like, right? I'm not a computer engineer. I don't know anything about this stuff. So I get frustrated because I don't understand all the hows. Andrew does. You see, he's calm and collected. He's like, well, I'm going to try this. I'll try this. I'll try this. Oh, didn't work. So we're going to do plan B. Me, I'm just like, why doesn't it work? You know, I paid this money for this thing to work. Like that was me. Well, same thing. You just want things to work. Well, many people that we meet when they want to invest because they want to become wealthy and they want the fastest way to wealth. But a lot of times people make a drastic mistake. I think this is one of the biggest mistakes people make. We're going to come back to this stuff in a second that I've penciled out here. All right, so let me just show you one of the biggest mistakes I feel like we make. All right, so X marks your Y. This is your Y right here. And in the way of your Y are lots of things, okay? We'll just put risk, put inflation, we'll put taxes. These are all headwinds, okay? We'll put theft, why not? Okay, we'll put debts. And we'll just put good old bad luck. All these stand from where you're at now to where you want to be, which is your why. So the first thing we do, and we're going to start doing this brand new thing called the blueprint. Okay, it's a 8-step process. I think we've made a lot of mistakes because we always try to get right to the why. What is it do you want? What are your goals? What are your dreams, right? We try to get here, but we often miss what is the client dealing with? What are the pieces in the middle that the client's dealing with? So a lot of times we try to take clients from the why or from the now to the why, and we don't fully understand all of this. And we don't because we have never had a cohesive client journey for all of our clients to take. We've never had steps that a client goes through, no matter who they are. I don't care if you have $50 million or $500 in your bank account. The process is the same. It's called a blueprint. So we basically are going to start doing blueprints, which is where we're going to walk you through an 8-step process. And we're going to learn exactly what these things are. We're going to learn what your why is, and we're going to learn where you're at. So then we have a complete blueprint of you, your financial situation, and your money problems. Because you know what all of these are? Money problems. Some people literally, when I ask, what's your money problem? Say, oh, I don't have any. I got plenty of money. I make a lot of money. I got blah, blah, blah. Everybody has a money problem. And you want to know what the biggest money problem that Private Money Club solves? Is people that have money, their problem is they want to make more money. And people that need money, you know what their problem is? They want to make more money, but they need money first. Every one of these are money problems. So once we understand these, it's very easy for us to solve the problem. So to solve the problem, we need to understand the problem, which is the blueprint. You'll hear a lot more of this going into the future, not today. Then what I started really doing is studying and saying, okay, well, complexity is another thing that stops people from doing things. Oh, that sounds complicated. That sounds like a lot of work. Oh, buying those I bonds, that sounds awesome. 9.62%. I covered this last week. 9.62% indexed for inflation. Oh, that sounds like exactly what I want. All right, we'll go to treasurydirect.gov and buy the I bonds. Oh, that sounds complicated. No, it's actually pretty simple. You're making it complicated. But what if there was a way, just like a wealthy individual focuses on one thing and one thing only. Can anyone tell me what a wealthy individual focuses on? What is it that all wealthy people focus on? Who can tell me? I love that right there. Greg got it pretty close. And I love it. Brian and Jade got it right. Keep it. Wealthy people, the difference between rich and wealthy is the wealthy have figured out how not to give the money back or keep the money. But wealthy people focus on money-making activities. They focus on making more money. It's just what they do. And it's not because that's what they want to do. It's just because that's the habits they've built in their life. That's just how they got where they're at. And when you build a habit, don't you just normally keep doing it? It's ingrained in you. So wealthy people have just gotten good at making money, money-making activities. So they just continue to make money, right? We all want to get there, but a lot of us stumble and trip because we're in such a rush to get to this why, which is money, that we make some bad mistakes. We make some bad mistakes. And one of those mistakes that we most commonly see is that a lot of people invest money. I don't care whether it's crypto. I don't care whether it's stock market, options, real estate, whatever, anything. They go out there and they take risk to invest money for an anticipated goal, and they skip the easiest path to wealth. They literally just hopscotch over it. They're just like, all right, well, yep, that's what I want. So I'm going to do whatever I got to do to get here. Great. I love the ambition, but hold on a second. Let's just go back here and let's erase all these, okay? And let's focus on one of the biggest mistakes people make, and that's skipping debts. When a recession hits, who are the people that get hit the worst in a recession? Can anyone tell me? Who are the people that get hit the worst when it comes to a recession? Some people are going to say, okay, actually, that's not correct. The poor are not the ones that get hit the worst. Highly leveraged people get hit the worst. Think of 2008. Who got punched in the face by Mike Tyson? Not just once, not twice. He hit him with a left, a right, and 2 uppercuts. Who were they? People that incurred debt through leverage. They were trying to grow so much, they just kept incurring debt. That debt came in the form of credit cards, lines of credit, everything else. They just kept building up the debts because they wanted the cars, they wanted the houses, they wanted all the things. And it was so easy to get those. Hell, let's draw a lawnmower, okay? They wanted the lawnmower with the big cup. Sorry, that's not a good example here, but they wanted the lawnmower that had the big cup. So they bought that. We financed all these things. So we had all these debts, and it was okay because, hey, now we were making a good income. So Parkinson's law, you guys should study it. Parkinson's law is basically simply put, when we make more, we spend more. When we make more money, we don't always spend all of it, but we finance the things we want, and those things come with a monthly payment. So essentially the income, it's dissipated by debt. So when a recession comes and our income drops or goes to 0 or unemployment, now all of a sudden the first thing we have is a major burden that will prevent us from getting here or push this way out into the future. The fastest way to wealth, folks, is to look at where your money goes today. Where's the hole in your boat? Well, I can tell you the hole in your boat is these things right here. So before you take on risk and everything else, what my team is designed to do, what Money School does, is we identify these problems, okay? And let's just say your credit cards cost you $500 a month, and let's just hit credit cards first because they're the worst of them, and you're paying 20% interest, $500 a month, and you're doing that. And let's just say your minimum's $100. So you're overpaying, trying to get those credit cards knocked down. Now, what most people will do is they'll just keep making the $500 payment. And then what they'll do is they'll hopscotch over into some investment because that investment pays them a 12% return. And then this investment might be in something that they don't know, like, or understand. So they're taking unnecessary risks, which we all know law number 4. If you seek unrealistic returns and take unnecessary risks, your money will flee you. They do this when they're going after, I want you to focus on this. Did anyone just see them? Let's do the math. The credit card debt's 20% interest. Visa is charging you 20%. Amazon's charging you 20%. American Express is charging you 20%. But you're investing the money that could pay off the credit cards. You're investing it to make 12%. Does anyone see how foolish that is? You're giving up 8%. You're literally stepping over 8%, just in the math there. And very few of you know how to make 12%. I know many of you have been around this campfire for a while. They're like, Chris, I know how to make 12%. I go to Private Money Club and I find that Chris Rude deal that just posted on there today, and I'm making 12%. Calm down. There's a bunch of new people on here that have never seen this stuff, don't even know what Private Money Club is. They don't, to make 12% to them is, let's put money in the S&P 500. That isn't working out so well. Oh, let's put money in NASDAQ. Those FANG stocks are going to do great, right? Yeah, sorry, till Netflix was down 63%. It was looking good and until you got punched in the face. You see what I'm saying? If your credit card's 20%, this is where you start. What we do is we take the money that you save, okay? And the money that you save, I know you want to see it in your bank account. I know you want it to make you feel warm and fuzzy. I know you want to give up control to the bank. There's just an itching urge in you to build that bank account so you can look at it. Don't be the victim there. Don't do that. The money that you save outside of the 3 or 6 months of emergency money should be moved over to pay these debts off. So let's just assume, okay, now that we got these, let's assume your savings is $10,000 and the credit card is actually, let's up the ante. Let's say the credit card is $8,000 and you're like, oh my God, I want to keep this as an emergency fund, and you're paying $500 a month. Okay, let's get the math. You're paying $500 a month, 20%, you got an $8,000 balance. You're just trying to pay that sucker off as quick as you can. You got $10,000 saved in your savings account and you're saving even more. But husband or wife, it's usually one or the other. It's like, oh, we can't use that. Don't touch that. I would tell you, touch this. Take 8 grand from this. Now you got 2K left here. Pay this off. But most people stop right there. They pay the credit card off and like, whew, honey, we did it. We did it. We are debt free. We paid that credit card off. It's been eating us alive. We don't owe anything anymore. Great. And then what do? Next month, they pull the credit card again. Oh, that's all right. We'll pay this off this end of this month. Oh, we got to have this, honey. We got to have this. Swipe it. End of the month, bill comes. You're like, shit, I don't have enough to pay it off. Cycle repeats. Here's how you beat the cycle. You add one step. The $500 a month you were given to that credit card, you change where that $500 a month goes. You were okay paying the credit card $500 a month. Didn't even think about it. You just wanted to pay it off. You were okay paying the credit card company 20% interest, but now you've paid it off. You're feeling uneasy because now you only have 2 grand in that sacred checking account at somebody else's bank. All you're going to do now, if this is gone, is you're going to change the name on the check. Instead of writing Visa, you're going to write your name. And that money's going to go back over here. $500, okay? So in 1 year, you have replenished $6,000, 7, 8. So now you got 8 grand back in. Now you're feeling good. Game's not over. I'm just showing you how this works. In 1 year, you've replenished all that, but you no longer are leaking 20%. You know what you're doing? You're making 20%. Every one of those $500 payments that goes back into your bank account, a traditional bank account at this point, is the same as you making 20% out there in the riskiest assets you can. How much risk do you got to take right now to make 20%? I'll be honest with me. How much risk would any of you have to take to make 20%? What do you guys got? You guys nailed it, man. If I had treats like dum-dum suckers like I did at the Money Multiplier Mastermind, I'd be handing dum-dum suckers out. You guys got it. A lot. So this is the simple foundation that I want to explain is the pivot. This is where the pivot starts. The blueprint and the team that's going to run the blueprint, this is what we're looking for. Where are you leaking? And how much are you leaking? Some of you might not be leaking a lot. Some of you might be like, well, I got a mortgage, but the rate's 2.75. Cool. Because now it might make sense to go out there and do a low risk investment like an I bond, which technically some would say is a risk-free investment, or a treasury bond, or maybe a private loan. Okay. Because those are pretty low risk, being that they're secured, and especially if you're first position, because now the spread's big enough. But before the spread was backwards, we were seeking a 12% return when we were leaking 20%. Now, if we start getting the debts down, now this becomes a difficult thing. Let's go one more round. Okay, you guys liking this? Is this good? You guys learning something here? This is bare bone basic stuff, but this is what we wanted to talk about. You don't need to be a mechanic to drive a car. Okay, you don't need to be an expert. You don't need to be a financial advisor. You don't need to be an analyst to run your finances. And if you go to an advisor, guess what they're probably not going to do for you? What I just did. Do you know why? No money in it. Man, advisors don't make any money telling you to pay off your debt and recycle and recapture the 20% you're giving away. No, there's no money in that. So what are they going to do? Let's put the money in that mutual fund. Let's open a brokerage account. Yeah, let's do one of those annuities. Commission, fees, and fees. They're not going to show you the thing you need to know. The blueprint team is going to show you this. Okay, let's go another round. Car. Now, we've been living in a fantasy world lately, but it's been cool, hasn't it? Hasn't this fantasy world we've been in been kind of neat? Like, you can go buy a car at 0% interest. Oh, I just got myself a new Toyota Camry. What's your interest rate? 0. Just got myself a Ford Raptor. What's your interest rate? 1%. Sweet as hell. But we get so wrapped up in the rate. So let's just pretend we're going to do a 0% car loan. Okay, we're doing a 0% car loan for this example. All right, let's just take all the numbers back. We got 10K in the savings. So you buy a car, it's 0% interest, and your payment's $600 a month. That's pretty common. Okay. Now, if you had, let's say the car was 40 grand. Now you had 40 grand in your savings account right here, 40 grand in your savings account, and you owe $40,000 on this car. Would it make sense to take the 40 from the savings to pay off the car if it was 0%? Who can tell me? That makes sense to pay off the car at 0%. And let's just say your bank's paying you 1% here. Yeah, right, Lynette. I mean, a lot of people are like, it's a trick question. It's really not. The answer is no. It wouldn't make sense because at 0%, your money's still working harder in the savings. But what you could do is you could take that money out, go out there, and let's just use 10% now, okay? And a private loan, do it for 10, take the payment from the 10%, and then pay the car, right? Now that might make sense. I'm not doing the math. I don't know what 30 or 40 grand at 10%. I mean, still it'd pay half of your car. Now we're working in the right direction. So now your money is working for you. But if this car loan was 5%, if any of you go to get a car right now, I'm telling you this right now, a used car loan is over 5%. I just checked. It's over 5% now. So now we're back in reality. We're starting to come out of that false reality world that we've been living in, which, hey, I agree, all of you, it's been fun. But everything comes and everything goes. There's a time and there's a place, and that time and place has gone. We're not in this low interest rate cycle anymore, and we may never be for the rest of our lifetimes. Who knows? Okay, 5%, 600. If you're making 1 and you're paying 5 now, would that make sense? Yeah, but it would still make more sense to do it with 10%. But I'm just saying you might not have the risk tolerance for this, so it still might. So I'm just showing you this is where it has to start. Doesn't sound fun. You're like, well, this is boring. Of course it's boring. I never said building wealth was some sexy, exciting thing that you've been taught to believe. The stock market is just the same as going to the casino, especially in today's world. I left Wall Street, not just because I got an HGTV show. That was the trigger that got me out the door. That was the motivation. Otherwise, I might not have left. It was easy. But the things I saw in Wall Street, I will tell you, it is a rigged game. You can't win it. You can't win it. You might win for a period of time, like the casino. You might be on a winning streak, and everybody comes over. You're rolling the dice on the table, and you've got a winning streak. Everybody gets behind you. They're putting their chips on the same one you are. Until what happens? You roll wrong once. Bad luck. I got it this time. You throw it again. Wrong again. A little more, your money goes. You roll again. Wrong again. The winning streak is over. Now you're on a losing streak. What happens? All those people that used to be behind you, all those people that were cheering you on, bringing you drinks, patting you on the back, they're gone. They're no longer following your lead. They're on to another sheeple that they're going to follow and probably lose their money, but they're going after the winners. We're all chasing the winners, folks. All of us are chasing the winners because it's fun. You want to chase the winners, go to a casino, set a dollar amount. Honey, we're only going to bring $3 grand because we can afford to lose $3 grand. right? How many of you gamble that way? I don't gamble, but how many of you go to the casino and you only bring an amount that you literally can afford to lose every penny? But if you make money, actually, how many of you do that? How many of you go to the casino? Okay, perfect. $100. I love that. She's just going for the free drinks. And she's like, when the 100's over, I have to have drank at least $100 worth of rum and cokes or whatever. 500 bucks. Man, Mike, heavy drinker. Just kidding. All right. So now when we go to the casino and we hit a winning streak, let's go. Listen, I know we're talking about money, but I am literally talking about mindset here, folks. But I'm talking about the same thing as the investing with your gambling. Any of you are at the casino and you have one of those winning streaks where everybody's behind you, everybody's cheering you on. How many of you just on your, like when you're winning, maybe you roll one bad, die and you're like, oh, it's a sign. Maybe two, whatever your threshold for risk is, 1 dice, 2 dice, or I don't care what you play, but all of a sudden you get on that losing streak. At what point do you cut the tie and how many of you actually gather up all your chips, walk over to what do they call that? The thing with the bars, put your chips there, cash out, and walk your ass back out of the casino? How many gamblers actually do that? I bet you statistically it's not many, because casinos wouldn't have any money. People don't know when to stop. They don't know when to hold them and when to fold them. They don't know when to take their gains off the table. And they certainly don't understand buy low and sell high. They're just in it for the thrill. And that thrill is the unrealistic returns that makes your money flee you. Now let's transition that gambler mentality over to the stock market. How many of you, when you buy a stock, have a set price that you're going to buy it at and a set price that you're going to sell it at? Be honest with yourself. How many of you actually know where you're going to buy and exactly where you're going to get out? And when it hits that number, you actually exit. Be honest. How many of you do investing that way? Took my winnings and took a trip to Grand Canyon. It's great. But how many of you invest that way? Take your winnings off the table. I don't know what the eyeball means. Limits are the key, right? But the thing is I'll bet you, and I'm not trying to make fun of you or put anyone on the spot, and I won't do that. I bet you less than 1% of you do that. And I bet you less than 1% of you go to the casino, and when you're up, you take the chips off the table, take the chips over to the, whatever that thing is, the cashier, and check out and leave. I bet you don't. You know when you leave? When you're down to your last chip. When the last chip is gone, when you've lost all your money, that's when you leave. Defeated, you leave exhausted because you've been trying so long to try to make that money back, and you just feel depressed. Well, the same is true with investing. And it doesn't have to be. Number one, we talked about like bleeding money here, but the other thing you bleed money is you seek unrealistic returns. You don't follow a set of rules. You don't follow a process for investing. And I get it. We're not trained to do that. It's just not fun. It's not fun at all. And I'm going to give you a sad sense of reality. Investing should not be fun. It should be a process. It should be procedural. You should have a set of rules based on your risk and reward profile. Risk reward means risk return profile. Set of rules. I'm willing to lose X, 5%, 10%, 15%. And after that, I'm out. My set goal is 30%. Well, when you make 30%, are you out? I don't know. When you make 30%, are you out of the market? Let me just show you something here, folks. And I'm glad I kind of drew all this stuff out because I had some great PowerPoints to show this, but unfortunately they didn't work. This is Bitcoin. How many of you, who here is a Bitcoin investor? Give me that. How many of you are Bitcoin investors here right now? Okay, me-ish, yeah. All right, cool, we got some. So now let's look at Bitcoin. When you trade Bitcoin, Ethereum, Dogecoin, I don't care, Cardano, whatever you are buying into, whatever you're trading, and it doesn't matter. Like, listen, they're all the same. None of them have intrinsic value, so technically they're all the same. Right now, let's just look, because I invest in Bitcoin and Ethereum, but I'm just going to do this live. So right now, Bitcoin is at 29,917. Now the market's down. Can anyone pull up? Oh, here, let's do it right now. That would signify that the markets must have taken a turn today, and maybe the markets are down. I don't know. Let's look, because we were up today, and now, come on. You know, technology loves me. Look at that. Can everybody see that? What color is that? Red? Do you all realize an hour ago, the market was up over 200 points? Now, I know that's probably hard to see for some of you right there, but right now the Dow Jones is down 247 points. The S&P is down 50 points. The NASDAQ's down 302. The NASDAQ's down almost 3% today alone. Therefore, Bitcoin is 29,000. This morning and yesterday and the day before and the day before and the day before and the day before, I have been buying Bitcoin and a little bit of Ethereum. Do you know why? It's been going down, down, and down. Now, I want you to look at this. I drew this a while ago. Some of you may have even seen a training at the 3-day event that we did. The last one, I showed this. See these levels? 30 to 40, 40 to 50. I just want you to look. You know, everybody see these levels. These are just levels, okay? Think of it as the floor and the ceiling. Think of your floor and your ceiling. It's all I want you to think about right now, okay? That's all these are. They're just levels. And in any skyscraper or any big building, when they add floors, they put a new floor and then they add a ceiling, right? But that can't happen until the floor is secured. Let me just teach you something really quick and really easy, and this is not difficult. So please, please, please don't make this complicated because it is not. A floor and a ceiling is created when a stock, or in this case, Bitcoin, touches that floor several times over a period of time. A shorter period of time is better. So we got 1 touch, 2 touch, 3 touch, 4 touch. Floor made. 1 touch, 2 touch, 3 touch, 4 touch. Pull up any chart and just grab a piece of paper and just put the paper on there and just be like 1 touch, 2 touch, 3 touch, 4 touch. 3 is good, but 4 is better. 1, 2, 3, 4. Everybody sees that? We got a touch there, a touch there, touch there, touch there. $30,000 level. Okay. So now I've solidified that I have a floor. And now I know one thing. Now that I've created a floor, I know for a fact that no matter where we go in the future, that is going to serve as a solid landing place for this particular security, Bitcoin here. And here it is, touched again, and then it didn't touch. We're up here, but we are actually touching this now. Now this is old, okay? So I don't bet in the future, but right now, are we not touching the $30,000 floor? Is it not having a hard time glowing over the last week or even longer? I think it hasn't gone below, maybe a slightly below, but 29 because there's a floor. It's hard to break through that floor, man. You need a jackhammer. You got to hit that thing with some force to break through that floor. Everybody understands the floor. The same is true for ceilings. So now, I mean, many of you have maybe ripped a ceiling out or two, but there's studs, there's all sorts of stuff. You got to hit that drywall hard, then it falls. You got to hit it hard to get to the next level. If you wanted to not take the stairs and just go through the ceiling, you got to put some effort in. So here, same thing, 1 touch, 2 touch, 3 touch, 4 touch. Ceiling. Now what I know is I know that that security, Bitcoin in this case, will run from that floor to that ceiling on a pretty consistent basis when it's in that range. So when it was in this range, if I bought around 30 or 32, you're never going to get it at the bottom and you're never going to get out at the top. Are we clear? You'll never get it at the bottom and you'll never get it at the top. I just want to make sure you guys understand that. That's called greed. You cannot time the market and you will never get a top or a bottom. I don't care how good you are. If you do, if you're like, well, you could, some of you might say, well, Chris, I did it. You got lucky. Probably can't consistently do it over and over. But if you have these levels, you can get close. So what I was doing, this is a while ago, this is December 20th, I would buy between 30 and then I would sell right around 40, 30, 40, 30, 40. Boring. You know, oh my God, people say, oh my God, you would have made so much more money, 30, 40. Then, you know, we bounced on this ceiling enough times, you know, and it ran through because I'm not showing you previously, but there would have been other touch points and it ran through. So now when it ran through, we've created a new floor and a new ceiling, but it ran through it ran up and it, man, this was an aggressive thing. It was running up there. One thing to be scared of is when a stock or Bitcoin or Ethereum runs straight up and it doesn't stop at levels. It sort of just makes a beeline straight up. Anything look that way now? How about everything? How about everything? S&P 500, the Dow Jones, the NASDAQ. It was like a beeline straight up. It skips through a lot of the normal processes for growth. And what that does is it creates a very, very weak floor, a weak foundation. So when it goes up high, it typically falls just as hard. And you can see that. It went up super high, touched around 60, fell back down into the range, which it had now loosely created between 40 and 50, traded in that range. But then it ran up around 68, and you can see here was our high. We've never really seen it higher than that, but everybody says, oh, it's going to go to 100, it's going to go to 100, it's going to go to 100. Now, maybe it does, but we got a lot of levels we got to cross, and we're now down around 29,000. So what does that mean? That means we're at a floor. That's a solid floor. It's hit this many times, and I probably have another one here, another one here, another one here. We probably have 6 more touch points. It's a strong floor. So if you buy at that 29 to 30 floor, and you sell at the 40,000 floor, or even, at 29, sell at 35 floor, what is that called? Can anyone tell me what that's called? It's called making money. Has anyone that you've ever met been upset that they made money? Has anyone you've ever met been upset that they've made money? Anyone? The answer is no. No, I've never met a single person that was upset that they didn't make money. But you know who's upset? The person that lost money that said, oh my God, you should have held on to that longer. You should have held on to that longer. You should have sold it at 40. My God, it ran up to 55. You should have held on to that. You know what that person did? Lost money. But you know what they are? A guru. A guru. They know all the answers, but yet they just lost money, and you made money, but you didn't make as much as they think they could have. Does that make sense? You made money. You locked in your gains. You sold, you followed a process. You followed a set of rules. I bought it at 30. I sold it at 40. You made money. But the guru comes in and says, oh, you should have held that around 55. You would have made way more money. That guru probably didn't make money, but they think they did in their mind. Their gambler mentality says you could have made more. Why didn't you stay in? Why didn't you keep playing, blackjack? Why didn't you keep playing craps? You could have gotten it all back. You could have made more. That is the exact person that defines the 4th law of wealth. The 4th law of wealth says if you seek unrealistic returns, your money will flee you. That guy or gal, their money fleed them, but yet they're still the expert. This is what you got to worry about today. The world is full of guru experts. And you know why? Because they've never seen the downside. They've never seen the downside. They've never understood what the Great Recession did to their finances. Maybe they saw it from afar, but they never lost everything themselves. We are in a very unique time, only to be rivaled by the booming 20s. Okay, the roaring 20s. About the only other time, maybe a few other times, maybe the dot-com craze, that you can actually look at it and say, you know what, there was periods of time in history where people thought that they just couldn't lose money. You know why? Because they never did. Because we're in the longest bull run history there ever has been. So I didn't want to get into a Bitcoin lesson, whether this is, if I just erase this and I say this is the S&P 500, would any of you known the difference? Would any of you, if I erase this, what would you have known that this was Bitcoin? Or would you have said, well, that could have been NASDAQ, Dow Jones, S&P 500? Good. Because it could have been all of them, and it would have been exactly the same. Please, in your investing, set your rules. And if you just don't know how, or you're just one of those people, I just don't know. Well, when we launch the blueprint process, please get on a call and create your blueprint that will set the metrics, that will show you how you're going to go from where you're at now to where you need to be. And you might not like the answer. That's the problem. When we come up with solutions to solve most people's money problems, some people don't like the answer. I hear a lot of yeah, buts, yeah, buts, yeah, buts. You know what I've started saying about yeah, buts? You know, those yeah, but things are little 3-eyed creatures that live in the woods. Why do you keep talking about them? Do you have one living in your backyard? I haven't seen one in a while. They're a 3-eyed creature that lives in the woods. Stop saying yeah, but. Yeah, but I could have made this. Yeah, but I could have done that. Yeah, but if we don't pay this off and we just do this. Yeah, but. Go in the woods. Get some reefer, go out in the woods and smoke, and you'll see all sorts of yeah, buts. They're 3-eyed. Actually, most of us call them rabbits, but I guess if you're high, they look like yeah, buts. I don't know where that came from. So right here, what I now want to do, and this is going to surprise some of you, especially into the newcomers. And Shauna, if anyone has questions or anything else, you sound like a motorboat. No, I know what a motorboat sounds like. I've watched the Vince Vaughn movie. So here's the thing. What I want to do real quick before everybody sees this, and I actually, let me turn this off. What I'd like to do right now, and I'm going to grab a pen. is I want to ask all of you. And Nick, you have hard questions, put them in the Q&A. So if any of you have questions, put them in the Q&As. And here's the thing, folks, I don't know if all of you know this, but we've got a 3-day event coming up in July. It's July 29th, 30th, and 31st. And we're going to be going deep into this. So I got an hour and a half with you today. I'm brushing the surface, man. I'm literally covering the surface. In the 3-day, this is what it's going to be about. Some of you are like, yeah, but we just got done at the Daytona. That was the infinite banking concept, and that was that. This 3-day is going to be a lot more tactical stuff like what we're talking about. Very, very right to the point of what's happening today and how you solve tomorrow's problem, how you're ready to not give money back in the future, how you're going to make a shit ton of money, excuse my language, when this storm hits. The storm is going to be the next recession. Signs everywhere. The market was up 200. The market was up 400 in futures, 200 during an hour ago. Now it's down 200. You want to know how you'd be making money in that play? You're going to learn that in the 3-day. So we'll put the link up for the 3-day. We only have 100 seats. We rented out a movie studio, like a movie studio where TV, news, and all sorts of things are filmed. You've seen them all. You've seen David Letterman. You've seen all these. Were you starting to say something?
It's 2 days. The third day.
I've been to the 3rd day. I haven't got there. It's a 3-day event, but it's only a 3-day event if you're a VIP. So there's 20. How many VIP seats do we have left, Sean?
The checkout page has the ticker, but I think there should be 18 tickets left.
So there's 20 total VIP tickets, but there's probably 18 left. So the VIP tickets cost a little more because that 3rd day, you know what it is? One-on-one time. It is you going to a baseball game. I don't care if you like baseball. We probably won't watch much of the game. Going to a baseball game where we rented out a suite, but it's not just a suite. It's a 50s themed diner suite. And we're going to literally spend the whole evening. This is the day after my birthday, just so you know, the whole evening in that suite, watching the ball game. And after the ball game, we're going to watch the fireworks. When the event starts the next day, the 2-day event, because it is technically 2 days of education and learning, the 2-day event, you're going to sit right in the front. We're going to serve you lunch. Okay, we're going to have like a VIP tour of the facilities. We're going to do podcasts with some of the VIPs. We're going to do all sorts of cool stuff. So the VIP tickets, there's 18 left. The rest of them, the general admission tickets, a whopping $297. I don't know, there's 100 total, but there's probably less of them now. So it's July 29th, 30th, and 31st. 30th and 31st if you're not doing VIP. And for those of you that like these trainings where they're virtual because you're in your underwear, cool. We've got a virtual ticket as well. You want to come to it virtually, we'll be doing virtual and live at the same time. So you can get your virtual tickets, but those are also $297, or are they $297 or $197, Sean? You would think I'd have these numbers down. Well, anyway, I'm not sure. The virtual tickets are between $197 and $297, but they're about the same as if you come live. So anyway, get your tickets for that. Come down. If you like what we're teaching here, that's what we're going to do. Now let's get into something fun here. The link's right on the chat, so grab it in there. Let's have some fun, okay? Let's design the perfect investment. In the chat, what I want you to do, virtual is $197. Sorry about that. Thank you. Yeah, in person is $297. I don't know. They're just numbers. If you could have your perfect investment, what would be the things that would make up your perfect investment? In the chat right now, what I want all of you to do, we got 150 people on here, so we should have no issue doing this. What's your perfect, 75 left for general admission? What's your perfect investment? Give me the characteristics of your perfect investment. I'm going to write them down. Okay, no risk, Mark Perry said. No risk. One forever, low cost. Okay. Okay. Perfect investment. So I don't have a crystal ball. Fishing. Okay. Guaranteed returns. High returns. Okay. Always goes up. Inflation proof. Autopilot. Sorry, I'm picking them up as quick as I can. You guys are doing awesome. These are awesome answers. Safe, passive. Someone else pays. Sustainable. Okay, sustainable. Okay. All right. So let me just kind of scroll back up. Exit strategies. So we got some real estate investors on here because that's how they're thinking. How do I exit this real estate deal? Let's see, some new ones just came in. Oh, I love that. I can't believe that's the first person. Devin is the very first person that gave what I thought would have been the first thing on all of your minds, and that's liquidity. Thank you, Devin. That's an awesome answer. Cash flow. Let's see what else we got. BYOB, I love you, Kevin. Let's see. Low buy, no interest, high compounding. Okay, compounding. I'm just going to put that down because I'm just trying to do like one-liners. Oh, tax friendly. I'm surprised nobody else said that either in today's world. Tax friendly. Scalable. Another real estate investor. What else we got? But yeah, I mean, these are great, folks. These are great. And I can tell a lot of you are real estate investors by your answers. Some of you are just like, you know, what's the perfect investment? You're like real estate. Mary Bauer said cars. That's a joke. Compound interest came up a few times. No risk, high returns is a good one. Quick return. James said quick return. I don't like that answer, but I'm going to put it down. Quick return. Keep chasing those quick returns. I mean, but we did say this is your perfect investment, but if you chase quick returns, your money will flee you every time. All right. These are freaking awesome. All right. So now that you guys have all seen everybody's answers on what a perfect investment is, does that perfect investment oh, okay. Hold on. This is good. Brian said something I'm surprised nobody else did. He said generational. Brian, is it okay if I just call that legacy? You know, it benefits the future family or whatever. Let's see, what? Digital products, 1,000% commissions. Well, that might be good for you if you're selling them, bad for everybody else. Let's see here. All right, perfect. And then automated. I'm going to write Alicia's down, automated, because a lot of people do want something that is automated. All right, so does that, all right, let's move on now. So now we've got everybody's idea of the perfect investment. Does that investment exist? Is there anything, and let me just read these off, okay, before you answer. And some of you are like, nope, but hold on, let me read this. We're looking for a place to put our money, an investment or just a storage of our capital that is no risk, low cost, guaranteed returns, also offers high returns, always goes up, inflation proof, autopilot, safe, passive, sustainable, exit strategies, liquidity, cash flow, compounding, tax friendly, scalable, quick returns. That's the only one I would put a question mark. Generational legacy and automated. Does that exist? Lynette said it did. Yeah, you're right. Some of these people have been around the campfire a little while, so actually they do understand that this exists. But how many of you didn't think this actually existed? Because it really does. This perfect investment, it's not an investment at all, but this perfect thing that hits every one of these things has been around for hundreds of years. Hundreds of years. It's been masked, I guess. It's been bastardized. It's been thrown under the rug. But yet back in the 1920s, 30s, 40s, 50s, it was the #1 place people put money because of all these things you just said. And all of you know what it is now. I mean, you all understand it. It is nothing more than the specially designed and engineered whole life insurance policy applied. So now some of you are like, well, no, that doesn't beat inflation and that doesn't give high returns. Sure it does. It provides liquidity and the ability for you to earn uninterrupted compound interest while going out and seeking high returns. Private loans at 12%. Right now, one of my favorite lenders or borrowers, the person I lend to, Rob Fuller, many of you know him. He's got a second position deal. Now, I trust Rob exclusively. I wouldn't suggest a second position deal for many of you, but it's an 18% interest rate. It's very short term. He's just kind of getting in and out of this thing, so he's paying a higher return. Most people should look at an 18% return and say, ooh, that's unrealistic. It is. Okay. I would say that's unrealistic. 12% is usually like, that's the return I seek, but I'm perfectly fine with 6%. And most of you are like, why, Chris, why would you be okay at 6% when you're making 8.5? I'll give you one answer for that. I'm not in a rush. I'm not in a hurry. I understand wealth takes time. So 6% compounded over a period of time. Hell yeah. That's anything I want. Ferrari, bigger house, whatever I want. 6% compounded over a long period of time, I'm winning. 18%, you know what that is? Unsustainable. You might get it in a sprint. How many of you can run flat out forever. Zero, none of you. Some of you are ultra runners. You're like, man, I don't know. Forrest Gump, the dude just kept running. Well, some of you might be able to do that, run full out, but most people cannot run full out. Well, your investments can't run full out either. Your money-making activities can't run full out. But consistency is the name of the game. Being consistent and persistent. Me and Greg Hurling talked about this at the mastermind out in Utah from the front of the room. And I thought it was miraculous. He literally said, I would be happier making a lower return that I knew, like, and understand, and that was sustainable. The room was like, really? Why? You of all people can make high returns. Of course you can. But he understands, because he's given it all back. He understands through failure and wisdom that the long game is best played slow and steady, the tortoise or the hare. So now let's just talk about some of these things. I drew them out. Okay. So let's just talk about these specially designed and engineered whole life plans, 5.2 to 6%. There it is. That's what you're going to get with the dividends right now. Okay. That's what you're going to earn, depending on the company, 5.2 to 6. The perfect investment, high rate of return. How many of you said that? A bunch of you. Can you get a high rate of return? Is 5.2 to 6% a high rate of return? No. But what if I could put money in, immediately take that money out in the next 30 days or less, and put it into that Rob Fuller deal on privatemoneyclub.com and make 18%? Is that a high return? You guys okay with 18%? Can you live with an 18% return? That's a high return. Okay, great. Check. Consistent rate of return, 5.2 to 6%. Consistently and persistently. Check. Conservative low risk protection. Conservative dividends. They've paid dividends consecutively, and depending on what company we're talking about, between 140 and 165 years. Very conservative. Low risk. Already answered that. Protection. Absolutely. How about guaranteed? Yep. Got all those. So I could actually literally throw the word guarantee. Do you realize in Wall Street, the word guaranteed is a swear word? Like when you're in Wall Street, if you say guaranteed, everybody looks at like you just screamed the F word, or even worse. It'd probably be like you screaming some other word, like C words. But in this world, that's just a common word. Oh yeah, guaranteed. Yeah, they're guaranteed. Yep, contractually guaranteed. Insurance company guarantees you contractually that they're going to pay you a guaranteed interest rate on that money. Cool. Check. Liquid. Now, when you put money in, you can immediately take that money out in the first 30 days. And many of you know that that's just our shtick. Like immediately in the first 30 days, it's a lot less. Devin from the front of the stage at the mastermind said he took his money out of his daughter's policy in how long? 2 days. Now, I don't say that because that might not happen for you, but definitely going to happen in 30 days. So it's liquid. Access to the cash if needed. Yeah, click a button. Is that quick enough? All you need to do is answer 4 questions and then tell the insurance company where you want the money. Do you want a check? Great. They'll mail you a check. Okay. And I sometimes have the checks. If I'm not in a rush for it, I just do the checks. I just like getting checks in the mail. Who doesn't like getting checks in the mail? I like it. So I just have the damn check sent. Everybody here has been trained. All my staff has been trained. When they get the mail, the first thing they deliver on my desk are the ones that look like checks. You know where the rest of them go? Shauna's desk. And then I'll sometimes make it back to my desk, but it's just fun. Getting checks is fun. Now I could do an ACH and have that money immediately sent over to my bank account. Okay. Where's the fun in that? Sure. I pull up my app and I'm like, all right, the money hit. Sweet. Money. Wow. Bitcoin's down 6.25. You guys hang on one second. I got to buy some of that. Just kidding. You should. Okay. So it's fun. Guarantees we already covered. Tax advantage. Well, how about tax free? All the money you make, this 5.2 to 6%, tax free if it's built right. Always has been. It's right in the tax code. Life insurance, the death benefit is tax free. So when you take loans, which are an advance or a loan from the insurance company of your death benefit, shit, it's tax free. And are loans ever taxed? No. Government's trying to tax it. Did you guys hear that? They're going to try to tax the equity in your houses when you take it out. They're going to try to tax the capital gains even when you don't sell the stocks. You hear about that? That'll never make it through, but just telling you that they're trying hard. I give them credit. Hey, sometimes you just got to give people credit for trying. Tax advantage, tax free. Are we hitting some of these things on here? Okay. No market volatility. So I'm going to hit these quick. No market volatility. Yields income, cash flow. That was a big one. Absolutely yields income, cash flow. What if I took the money, I put it into my private banking policy the whole life, and then I immediately took it out and I bought some real estate? I'm making money twice. Real estate investors on here. How many times are you making money when you take money from your bank account and you buy your real estate? You're making money once. Once. You're getting the rents or the profits or whatever you're getting from the real estate. What if all you had to do is just change one thing and now you're making money twice? Well, shit, that's twice as fun. Okay. Yields, income, cash flow, check. Creditor protected. We didn't bring that one up, but we can talk about it. Someone slips and falls at that awesome new apartment building you just bought, and you live in Buffalo, so it's ice all winter long. Someone slips and falls. They sue you. Or better yet, you hire someone to come clean your gutters. The ladder gives out. They fall. They break their ankle. You're done. You cannot, let me repeat, you cannot win that lawsuit. You lost. It's game over. It's called the ladder law. Look it up. But all the money that you have inside this stupid whole life policy, which is specially designed and engineered, is creditor protected. Who loves that? Surgeons. Who else? Anesthesiologists. Who else? Professional athletes. Damn right they love it. Ask O.J. Simpson. Okay. Inflation protected. Well, 5.2 to 6, when I did this, that would beat inflation. But today it's 8.5. So now we got to add an extra step, and that's the infinite banking process. The infinite banking concept is a process. And now to beat inflation, we have to move that money. Piece of cake. We can put the money in and immediately take that money out in 30 days, pay off those credit cards, take back the 20% we're giving, pay off that car loan, take back the money, and you made money twice there. If your car loan was 5, and then you're making a spread between what the insurance company is paying you, let's just say 6, and what the insurance company is charging you, let's say 4, you're making a spread, you're making money twice, you're close. Or you take the money out and you put it in one of the deals in Private Money Club. You loan the money 10%, 8%. Now you're beating inflation. You see? Yeah, we can definitely do that. Control of your money, 100%. 100% control. No matter what. No one asks you questions when you want to take the money out. When you go to the bank and you want to take a large withdrawal, can anyone on here tell me, if you've gone to the bank to take out a large withdrawal, do they just say, nope, no problem, Mr. or Mrs. whatever, here's your money? What do they say? Come on, somebody here has gone into a bank and somebody here has tried taking money out of the bank. Have they not? Okay, my parents couldn't cash a $10,000 bond. We don't have that much here. Under 10,000 is no issue. Patrick said yes. You'll have to make an appointment. Yep, here's your lollipop. Dum-dum. They don't have it. Yep. And well, we might not be able to give you all of this today. Could you come back later this week? No, I need it now. I'm buying this house down the road and it closes today. I need my money today and it's got to be cash. Sorry, we don't keep that much money. Well, what's in that vault? Oh, nothing. It just looks pretty. You want to check it out? Nothing in there. You mean my black box with my money in it isn't in the vault? Who's been lying to me all these years? You're right. And then what do you got to do? When you take a big withdrawal out of your bank, okay, over 10 grand. So that's hardly a big withdrawal. Anyone would agree, any of you would agree, right, that over 10 grand is not really a lot of money, but once you breach 10 grand, what do you got to do? Oh, we got to have you fill out some paperwork, sir. You're gonna have to pay taxes on this money. All right, anyway, you get the point. Transferable ownership. You can transfer your bank account. You can transfer your IRAs. Oh, whoops, you can't. You can change beneficiaries, but you can't transfer them. These policies, you can transfer ownership to anyone. Anyone. You want your daughter to own it? Great. You want a trust to own it? Awesome. You want your foundation to own it? Sweet. Transferable and easy to manage. What management? The money, the mapping team does all the management for you. They do all the tracking. You just tell them what you want, what problem you're solving, they do it all, right? So everybody understands that. Sean, are you with me? Oh, no hidden fees or penalties. Sorry, there's some more. No hidden fees or penalties. That's right. No hidden fees or penalties. So we show you on the illustration what the cost of the insurance is. It's a $50 or $100 policy service fee per year. You don't pay us unless you go through the blueprint and do that, but that isn't here yet. So no fees or penalties. When you take money out, there's no penalties for taking it, no surrender charges, and no taxes because you're taking a loan. Reputable, trustworthy, legal. Absolutely, it's definitely legal. These companies have been around for hundreds of years, so they're reputable and very trustworthy. And then right in the name, private. Private, private, private. You with us, Shauna?
Yep.
All right. So Shauna, one thing I'd love to do right now is, now that we've kind of explained all that, I'd like you to, because I didn't see it and not many of you did, I'd like you to toss up the 90-minute video. So any of you that have not seen the 90-minute video, if you could just watch this video, it'll change your mind, or it'll change your viewpoint. Because I remember when I watched it in 2014, it was one of the greatest things I'd ever seen because it changed everything. All right. So Nick said, I recently became disabled in the last 2 years, waiting on Social Security with my lost income, trying to make it on just my wife's teaching salary. We are in the basement. Okay, so Nick, I think one of the things, that's a tough situation. It really is. And I always tell people, like with the private banking and the infinite banking concept, we can't help everybody. Well, we really can, but I'm just going to tell you, we can't help everybody. If you're living paycheck to paycheck and you're not saving money, it's very difficult. But maybe the answer is not setting up a banking policy. Maybe the answer is figuring out where you're at now, where you want to be, and what steps do I have to take to get where I need to be. The only thing you got to be is in no rush. I bet you any money, Nick, you're leaking a lot of money. Okay. I bet you, even though your income was hit and you're living on one salary, I bet you any money, a bunch of money is flowing out of your family each month. It doesn't need to be, but it is just because of unforeseen things or, whatever. So that is not something that cannot be solved. Don't think that you're, special and alone on a little island. There's a lot of people like you. Patrick said, doesn't FINRA state financial advisor can't guarantee anything? Yeah, so Patrick's right. So he's talking about a financial advisor, okay? They can't guarantee anything. They really can't. FINRA would be up their ass, and you don't want to monkey with FINRA because FINRA literally is the equivalent of the Gestapo or the equivalent of the mob. They really are. That's why I don't have my security licenses anymore. You can't guarantee anything as a financial advisor. If you did, like I said, it's like saying the C or the F word when you're in the office screaming it. People don't like that. You just don't say it, because no investment. I want everybody, when people say, oh, I want to invest in one of those specially designed and engineered whole lives, you can't. Sorry, you can't. And some people are like, oh, well, I kind of want to do that. What do you mean I can't? Well, it's not an investment. An investment involves risk. This is not an investment because it involves zero risk. Where's your risk? It's guaranteed. As long as you look at the guaranteed column, it's guaranteed. The dividend is not guaranteed. The dividend can change and does change. Over 30 years, the change has been down. Okay, dividends have gone down over a 30-year period. We're at the lowest dividend scale in history. So whatever you're looking at now, whatever the dividend scale is today, it's the lowest it's been in 30 years. That's that. So thanks for chiming in, Patrick. That was a great comment. Mike, I'm a contractor and I receive deposits from customers, which I place in an escrow account. Do you think it would be okay to place the money in the policy? I would consult with your attorney. There are some things that would allow for you to do that. I don't know if yours would allow for that. It just depends on liquidity and everything else. I know like custodians can. Certain custodians within the banking rules, they're allowed to store money in insurance companies because of the guarantees that are provided. But with yours, if you're a contractor and you're getting deposits, the only thing that would bite you in the ass, Mike, is the fact that you don't have immediate, like you don't have access to all of the money. So let's say you got 50 grand in deposits and you put it into this policy. Number one, there's no consistency behind that 50 grand. Number two, you're not going to have access to all 50,000 immediately. Okay. You're going to have access to at most 92%. I just designed one this morning, a big policy, and she had access to 92%. So we can consistently get between 85 and 92% pretty easily. But I would say the answer probably would be, it'd be tough, Mike. You'd have to consult with your attorney to see if that would be allowed. And then if you were going to do that, make sure that, the money that's being held in escrow, you have a long enough runway where that's actually going to work based on the numbers in the policy. And then Patrick said, so how can you ease somebody's fears? Oh, I'm sorry. I was reading it wrong. How can you ease somebody's fears on money and what's going on? I don't know if I can ease your fears on what's going on. Your fears would have been eased if you just been listening to what we've been saying for probably 2 years now. If you just follow simple strategies, buy low, sell high, and don't lose money, but don't forget to sell high, which many people have. Other fears, so, it's people's fears with money are typically associated with risk and with loss. That's where the fear comes from. So if I can just eliminate risk, okay, and I can eliminate loss, well, then I've pretty much eliminated fear. I can't always eliminate all the risk because lending money, like I showed you, is absolutely carrying some risk. The risk is mitigated because you have a tangible real estate property that you are in a first secured lien on. Like you're number one, you're Ricky Bobby. If you're not first, you're last. So Patrick, I don't think I have the ultimate silver bullet. I certainly don't. This specially designed and engineered whole life isn't a silver bullet. It's not the one stop. I mean, if it was, why would you ever need a family office? Family office work with wealthy individuals over $10 million. That's like the entry point. So some of you on here might be on here that can do a family office, have 10 million. Let's see. Patrick said, regarding my last FINRA questions, because you can't make guarantees. Sorry, should have made that clear. Regarding my last FINRA question. So first off, Patrick, I'm not talking about securities. Okay. I'm not talking about stocks in a this stock or that stock. I'm talking about a whole life insurance policy. In the contract, it has a guarantee. I absolutely can say the word guarantee because in the contract, it says guarantee. So I'm not saying that the loans you're making in Private Money Club are guaranteed. They indeed are not. Okay. They're investments which involve risk. And there's paperwork that you will sign that will say, do you understand the risk? And the same thing, when someone says, okay, yeah. Maybe I was just reading too deep into that last one, but yeah, I mean, so that's all. So Patrick, what I was talking about with guarantees is I'm only referring to the whole life policies, the machine we use to deposit money into and then move money out. Where the money moves out to, that might involve risk, but is there any risk in paying off your credit cards and recapturing the money? Nope, no risk in that. Like if you pay off your credit card and you write the same check you were paying Visa back to yourself, there's no risk in that. But you made you recaptured 20% you were giving away. I can't say you made 20%, you recaptured 20% you were giving away. That's all. All right. How do I get an infinite banking policy? Where do I sign up for Money School? Carmen, easy. So Shauna will put a link up just in a second. So just check the chat in a second. She's going to put a link up on how you set up a call with us. And then we will help you get started with that. And the Money School, you're in it right now. And Money School is a process. Okay. So Money School, all we do is we teach you how to become your own bank. We teach you how to solve your money problems by putting you back in control of your money. That's all we do at Money School. We do that through a process. And that process is being developed as we speak. It will probably be available in a week, 2 weeks. It is called the Blueprint process. So that's how you get part of Money School. Or Money School is the 3-day event sorry, Shauna, the 2-day event, if you're not VIP, that we have July 29th, 30th, and 31st. So right there is the link if you want to book a call with us and talk about setting up your specially designed and engineered whole life. So as we got a couple minutes left, I want to talk about one other thing that I find fascinating, and then we are going to get out of here on time. Can you imagine that I'm actually going to finish on time today? All right. Family offices. I'm infatuated with them. I don't know if any of you know what they are, but the wealthiest families, that there are, all use family offices. And they use a family office because their needs and their desires are that of which a normal advisor typically can't fulfill. They have a lot of needs and goals. They have trust. They have foundations. They have needs to want to invest in private investments, not available to the public, maybe just available to accredited investors. They want someone that holistically can look at everything they're doing and advise them on the whole thing instead of just, oh, well, can you help me with my IRA? Help me with my brokerage account. Help me, buy stocks. Help me buy mutual funds. They're going to look at it all. They're going to look at the why, and they're going to figure out everything you've got, and they're going to focus on how do we not give this money back? Protection first, growth second, or maybe even sometimes third, and legacy. Family offices are masters at legacy, and they're masters at making sure that that wealthy family doesn't give the money back through an unforeseen thing like a Medicaid or Medicare, a long-term care situation. So they're not going to give the money back if that person gets sued. The whole family doesn't suffer. They protect the money first. It's the third law of wealth. Family offices follow 6 laws of wealth, maybe 10, but I'm just only writing the book on 6 laws of wealth. Family offices follow them. So wouldn't every one of you love to have a family office? You would. You'd love to work with a family office. But the problem is, to work with a family office, all you need is roughly $10 million. Now, some of you might say, oh, I know a family office that does less. Okay, well, all right, great. The other thing is, here's what, and I just went through some of the basic stuff that you get with a family office. You get a team, a holistic approach. We already talked about that. You get a white glove concierge service. I'll tell you that much. I work with some family offices. As a matter of fact, I'm engaging a family office to work with me and my family, which me and my family is just me and my wife and my daughter. Like I don't come from a family with money. So that's it. I am the family. Like Ed Milet talks about the one. In every family, there's the one. The one. the one that goes out there, the outlier, the one that goes after what they want, that doesn't listen to everybody else, that doesn't let other people's failed dreams and failed realities stop them from chasing their dream. I am that one. Are you? I'm the one. And I realize that. I'm the one that's going to allow my family in the future to live a better life. I'm the one that's going to allow my daughter's children to live a better life than I was able to. I'm the one. Ed Milet says that every family has the one. The question is are you the one? Okay. And because I'm the one, I take that very serious, and I take that not lightly at all. I don't want to give it back. I don't want to disappoint that. There's a lot riding on me. Now, if I leave this world, if tomorrow a bus hits me and takes me out, I almost got hit by a semi truck. Me and Cassie, actually, I just pulled out of my development. I'm driving. It's super early in the morning. Sun's in my eye. I'm just going straight. And all of a sudden, I kind of see there's a semi truck coming, and the semi truck veers into my lane out of nowhere. Like, I didn't really have time to react. Luckily, the car I have has that thing that jerks the wheel, and it jerked the wheel over to the side. I thought I was going to hit the tree, but the car stayed on the edge of the thing. That could have been my day. That could have been the day that I graduated. And unfortunately, me and Cassie would have went it together. I didn't. Technology was beautiful there, not unlike it works sometimes, I guess. But if I left, if I was no longer here, my family would have been taken care of. My family would have still lived a better life. The world doesn't end with me. The financial freedom doesn't end with me. I've made sure to provide a legacy, the sixth law of wealth. So they get a white glove service. They got private investment options not available. Private investment options not available to the public. How cool does that sound? On-staff analyst. They literally have an analyst that analyzes things before you ever even get to hear about them. That private investment, yep. The analyst has run report after report, done all the due diligence. Wouldn't that be cool? You're out there doing money-making activities while there's an analyst making sure that the investments you are looking at based on your risk and return profile are within your family's goals. Legal and accounting teams on staff in some cases. Extensive experience. They have failed, and learned. They have wisdom. Some of them are multi-generational. They're not focused on commissions. They're focused on solving your problems. Shit, if every advisor just operated under these pretenses, man, we'd have just an unbelievable world, and nobody would be on this right now. We still wouldn't have 133 people on here. The problem is you don't have access to this unless you got about 10 million bucks. Until now. I have been working hard. Some of you have been on here with Andina Family Offices, okay, which is a family office, a big one for that matter. Look them up. And we are working on it. I can't say that I fully got it done, but we are working on doing something very special. So you may not have $10 million, but do you have a fractional piece of $10 million? Indeed, you do. So through a process called the blueprint, when we uncover where you're at, what your needs are and what your why is and what's standing in your way from where you're at now and where you're going to be, what we can do, and it's not going to be for everybody, but what we can do is offer you a fractional CEO in your family office. In other words, we're going to give you access to the same things that a family office offers, but we're going to give it to you no matter what income level you're at. And we're going to focus that concierge, okay, which is going to be called your fractional CEO, because that's what it's going to be like. It's going to be like you hiring a CEO, but it's a fractional. But you're not going to get the services of a fraction. You're going to get the full CEO experience. Okay, so we're designing this as we speak right now, and we're going to be rolling this out to all of you soon. Can't tell you when, but soon. We're testing it now. We're building the infrastructure out. I've got a couple calls to make sure that some of the pieces are there. And here's the thing. I'm not an engineer. I don't think like an engineer. When I launched this blueprint process, which is already done, when I launch it, it's not going to be perfect. Matter of fact, it will never be perfect, because perfection once you reach perfection, you've arrived. There's no perfection. It doesn't exist. I will always make it better. It will continually evolve as we get more and more people in, as we bring on more and more people that hire the fractional CEO. That's going to basically be it. There's going to be a whole bunch of things, cool trips, retreats, Mexico, Utah, all sorts of stuff. So I just want you all to know that this is coming. You soon will have access to a family office. Right now, you have access to the infinite banking concept through our team. Shauna put the link up again. Right now, you have access to spend up to 3 days with us, July 29th, 30th, and 31st, or just come for 2 days where we dive deeper into this stuff. I glazed over the surface. But back to the beginning, you need to start focusing on your why. It's not the how that's going to get you there. You don't have to be a mechanic to drive a car, like I said earlier. Hell, you don't even need to know how your car operates. You just need to know, turn the key, hit the gas, go to point B or C or wherever the hell you're going. It's the why. Don't let the how stop you from getting to your why. If you know the why, the how just automatically happens. That's it. It's that simple. Stop being your worst enemy. Stop seeking unrealistic returns. Start following 6 laws of wealth. The blueprint is literally 6 laws of wealth. Where do you fit? That's all it is. That's all it is. So right there in the chat, folks, Shauna just put it up. I'm 1 minute over, but Shauna just put the link up for the July event. Grab your seats. Don't wait to be the end. Don't be like, oh, I shoulda, coulda, woulda. I waited to the last minute and then they sold out. We will sell it out. We only have so many seats. That's it. I'm not making that up. I know a lot of these, I don't want to call them gurus, but a lot of the people out there, they say, oh, limited seats, we're almost sold out. No, you're not. When you see that they're almost sold out, they're usually probably a quarter sold, but they're going to make you feel that for the urgency. I'm being serious. We have 100 seats. I could show you the place. And we have 20 VIP seats, not a single one more. When it's sold out, it's sold out, period. Just like the Daytona Mastermind. The only reason we opened up more seats is some people couldn't come. Some got COVID, things happened, they couldn't come. That'd be the only way you'd get in after the fact. So let me just see, do we have any questions in closing? I'm happy to answer a couple questions real quick. The price for the VIP, yep, some people were asking. $997 for the VIP. Okay, you get the suite, you get to spend Friday at the ball game with us in the suite. General admission $297, virtual $197. Let's see. Can I walk there? Kevin, actually, you probably can. It might be a long walk, but plane will get you here. Then there's an Uber to get here from that. Let's see. We got that. The links are in there. Thank you, Francisco. Appreciate it. Thanks, Kevin. Place was packed. Yeah, Daytona was standing room only. Literally, people were coming in and there was no seats. We had to bring in more seats to sit them in the back. I stood the whole time. My legs are still killing me. Will the fractional CEO blueprint be included for people who already have a policy with you? Yeah, Alicia, it has nothing to do with the policies. The policy is just a component, but it doesn't matter whether you have one. You might already have a policy in a self-directed IRA. The fractional CEO is different. It's not a product. It's a service. It's us bringing you the experience of a family office and everything that comes along with that, and a couple other really cool things that we haven't talked about, and all of that comes along with it. So it's not if you want the money multiplier, if you want to get into the privatized banking, well, then let's just get on a call. That's all there is to it. If you haven't seen the video, we just ask that you watch a 90-minute video first, and then we will get on a call and answer all your questions. Here's what we won't do, and this might upset some of you. When you get on a call with us, we might not do is sell you something. And I know some people are like, oh, really? Well, what if I want to buy? Well, then you can ask us. After we answer all your questions, if we can solve your problem, then ask us to help you, and then we'll get you started. I'm just saying we're just not going to sell you something. You're not going to get on there with like, all right, so, here's the different packages. Which one would you like to buy? No. The money multiplier process, the private banking is one of just, if we solve your problem, then hell, why wouldn't you do this? And you should ask us to help you do it. And that's how we operate.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.